On March 27, 1980, two Texas oil billionaires named Nelson Bunker Hunt and William Herbert Hunt controlled more silver than any private individuals in history, approximately 200 million ounces worth, over $6 billion, representing roughly 1/3 of the world's investable silver supply. Their systematic accumulation of physical silver and futures contracts had driven prices from $5 per ounce to over $50 per ounce in less than 2 years, creating the largest commodity manipulation scheme ever attempted, while generating paper profits that exceeded the gross domestic product of most nations. These weren't Wall Street financial engineers or sophisticated commodity traders. They were Texas wildcatters who had inherited enormous oil wealth and decided to apply the same aggressive tactics that worked in petroleum exploration to cornering the global silver market. But their ambitious attempt to control silver prices would trigger the most dramatic commodity market collapse in financial history, destroying $4 billion in wealth within a single day, while threatening to bring down major banks, brokerage firms, and the entire precious metals trading system. The Hunt brothers' Silver Corner represented the last great attempt by private individuals to manipulate global commodity markets through sheer financial power, demonstrating both the enormous possibilities and catastrophic risks of concentrated wealth in unregulated markets. Their spectacular rise and fall would reshape commodity trading forever, while providing a cautionary tale about the dangers of leverage, market manipulation, and the belief that unlimited money could overcome fundamental economic forces. This is the story of how two oil heirs nearly broke the global silver market, lost their family fortune, and changed financial regulation forever through the most audacious commodity speculation scheme in modern history. The America of the 1970s that provided the backdrop for the Hunt brothers' silver speculation represented a unique convergence of economic uncertainty, financial innovation, and regulatory gaps that created unprecedented opportunities for wealthy individuals to influence global commodity markets while avoiding the oversight mechanisms that would later prevent such massive manipulation attempts. The decade's combination of inflation fears, energy crises, and monetary instability created perfect conditions for alternative investment strategies that seemed to offer protection against traditional financial assets. Haroldson Lafayette Hunt's oil fortune, which his sons Nelson Bunker Hunt and William Herbert Hunt inherited, represented one of the largest accumulations of private wealth in American history. Built through wildcatting operations in Texas during the early 20th century, when petroleum discoveries could create instant fortunes for individuals with the courage and capital to pursue high-risk drilling ventures. H.L. Hunt's success in identifying productive oil fields had generated wealth estimated at over $2 billion by the 1960s, providing his heirs with financial resources that exceeded those available to most corporations. The silver market that would become the focus of the Hunt brothers' speculation was relatively small compared to other commodity markets, with annual global production of approximately 400 million ounces and above-ground inventories that could be influenced significantly by large private accumulations. Unlike gold, which was held primarily by central banks and governments, silver existed largely in private hands through industrial stockpiles, investment holdings, and decorative objects that could potentially be mobilized for trading if prices reached sufficient levels. Commodity futures markets during the 1970s operated with minimal regulatory oversight and position limits that were easily circumvented by sophisticated traders willing to use multiple accounts, offshore entities, and complex financial structures. The Commodity Futures Trading Commission, established in 1974, was still developing effective surveillance and enforcement capabilities, while traditional commodity exchanges maintained self-regulatory systems that proved inadequate for detecting and preventing large-scale manipulation schemes. Inflation concerns that characterized the 1970s economic environment included double-digit price increases that eroded the purchasing power of traditional investments, while creating demand for alternative stores of value that could maintain their worth during periods of monetary debasement. Precious metals, particularly gold and silver, attracted increased investor interest as hedges against inflation, while benefiting from psychological associations with monetary stability and intrinsic value. International monetary instability following the collapse of the Bretton Woods system in 1971 had eliminated fixed exchange rates, while creating uncertainty about the future of paper currencies that encouraged investment in tangible assets with intrinsic value. The abandonment of gold backing for the dollar had created new dynamics in precious metals markets, while reducing traditional governmental constraints on gold and silver prices. The Hunt family's previous experience with commodity speculation included unsuccessful attempts to corner soybean markets during the 1960s and various agricultural commodity investments that had provided mixed results, while demonstrating both the potential profits and substantial risks associated with large-scale commodity speculation. These earlier experiences had taught the brothers about market mechanics, while providing confidence that their financial resources could influence commodity prices substantially. Political and social attitudes during the 1970s reflected deep skepticism about government economic policies, paper currency stability, and traditional financial institutions that had been discredited by Vietnam War costs, Watergate scandal, and economic stagflation that seemed to defy conventional economic theory. This environment created receptive audiences for alternative economic theories that emphasized hard assets and tangible wealth over paper financial instruments. Technology limitations that characterized 1970s commodity trading included manual record-keeping systems, telephone-based communication networks, and settlement procedures that made real-time market surveillance difficult, while enabling sophisticated manipulation schemes to operate for extended periods before detection. Electronic trading systems and computer-based oversight mechanisms that would later prevent such manipulation did not yet exist. International silver supply sources that would influence the Hunt brothers' strategy included major mining operations in Mexico, Peru, Canada, and the United States, along with significant above-ground stockpiles held by various governments, industrial companies, and private investors worldwide. Understanding and potentially influencing these supply sources became crucial elements of any strategy to control silver prices over extended periods. The legal and regulatory environment that governed commodity trading during the 1970s provided minimal constraints on position sizes, manipulation activities, or coordination between related parties, while enforcement mechanisms remained primitive compared to later developments. This regulatory vacuum created opportunities for large-scale speculation that would be impossible under contemporary oversight systems. The broader economic context of 1970s America included energy crises, declining industrial competitiveness, and growing federal budget deficits that created uncertainty about traditional economic policies while encouraging alternative approaches to wealth preservation and investment strategy. The Hunt brothers' silver speculation emerged from this environment of economic uncertainty and regulatory inadequacy, while reflecting broader concerns about monetary stability and asset preservation that characterized the decade. Oil money. The vast petroleum fortune that provided the foundation for the Hunt brothers' silver speculation originated with Haroldson Lafayette Hunt's extraordinary success as a wildcatter in East Texas during the early decades of the 20th century, when oil exploration remained largely a matter of geological intuition, financial courage, and incredible luck that could transform modest farmers into multi-millionaires virtually overnight. H.L. Hunt's discovery of the Joyner Field in 1930, along with subsequent petroleum ventures throughout Texas and Louisiana, had generated wealth that exceeded that of most European royal families, while establishing the Hunt family among America's richest and most influential dynasties. The inheritance structure that transferred H.L. Hunt's petroleum empire to his children reflected both his personal beliefs about family responsibility and his strategic understanding of business organization and tax optimization. Nelson Bunker Hunt, born in 1926, and William Herbert Hunt, born in 1929, represented the most business-oriented of H.L. Hunt's 15 children, inheriting not only substantial financial resources, but also their father's aggressive approach to high-risk investment strategies and skeptical attitudes toward conventional business wisdom and government economic policies. Nelson Bunker Hunt's personality combined his father's entrepreneurial instincts with sophisticated understanding of global commodity markets and international political developments that would prove crucial for the silver speculation strategy. Known for his brilliant analytical mind and willingness to pursue contrarian investment strategies, regardless of conventional wisdom or social pressure, Bunker Hunt had already demonstrated his appetite for large-scale speculation through previous investments in agricultural commodities, international oil ventures, and alternative investment strategies. William Herbert Hunt, while less publicly prominent than his older brother, possessed complementary skills in financial analysis, operational management, and strategic planning that enabled effective coordination of complex investment schemes across multiple markets and jurisdictions. His careful, methodical approach balanced Bunker's more aggressive instincts while providing the detailed execution capabilities necessary for implementing ambitious commodity speculation strategies successfully. The family's oil business operations during the 1960s and 1970s provided cash flows that exceeded the requirements for normal business reinvestment, while generating enormous surplus capital that required alternative investment outlets capable of absorbing hundreds of millions of dollars, while potentially providing returns commensurate with the risks of petroleum exploration. Traditional investment options, including stocks, bonds, and bank deposits, seemed inadequate for wealth preservation during periods of high inflation and monetary uncertainty. Previous commodity speculation experiences had provided the Hunt brothers with practical education in market mechanics, price manipulation techniques, and the psychological factors that influenced commodity trading, while demonstrating both the enormous profit potential and substantial risks associated with large-scale speculation in relatively small markets. Their unsuccessful attempt to corner soybean markets during the 1960s had taught valuable lessons about position management, regulatory responses, and the importance of maintaining public relations and political relationships during controversial investment activities. The political and economic philosophy that guided Hunt family investment decisions reflected deep skepticism about government economic policies, paper currency stability, and the long-term sustainability of debt-based monetary systems that had evolved since the abandonment of gold standard backing for major currencies. This philosophical framework provided intellectual justification for massive investments in tangible assets that would presumably retain value regardless of political developments or monetary policy changes. International business relationships that the Hunt family had developed through petroleum operations included contacts with Middle Eastern oil producers, European financial institutions, and Asian commodity traders who could provide market intelligence, investment opportunities, and logistical support for complex international commodity transactions. These relationships would prove crucial for implementing silver accumulation strategies that required coordination across multiple countries and currencies. The family's reputation for independent thinking and willingness to challenge conventional wisdom had been established through various contrarian investment strategies, political activities, and business ventures that demonstrated their commitment to pursuing opportunities regardless of social pressure or criticism from established financial institutions. This reputation for independence would both help and hinder their silver speculation efforts as markets and regulators responded to their activities. Financial resources available to the Hunt brothers for commodity speculation included not only their inherited oil wealth, but also access to substantial borrowing capacity based on petroleum reserves, real estate holdings, and other business investments that could serve as collateral for margin purchases of commodity futures and physical silver acquisitions. Contemporary estimates suggest that the brothers could access over $1 billion in investment capital during the late 1970s, providing financial firepower that exceeded the resources available to most institutional investors. Risk tolerance that characterized Hunt family investment philosophy reflected their experience with petroleum exploration, where enormous potential rewards justified substantial risks, while success often depended on commitment to contrarian strategies that seemed foolish to conventional observers. Their willingness to bet substantial portions of their wealth on single investment themes reflected confidence in their analytical abilities and determination to pursue investment strategies that could generate extraordinary returns. The market analysis capabilities that the Hunt brothers possessed included sophisticated understanding of supply and demand fundamentals, price trend analysis, and geopolitical factors that influenced commodity markets, while providing them with information advantages over typical retail and institutional investors. Their analytical framework emphasized long-term structural changes in global economics that would influence commodity prices over decades rather than short-term market fluctuations. Business organization structures that supported Hunt family investment activities included multiple corporations, partnerships, and trust arrangements that provided operational flexibility while optimizing tax obligations and regulatory compliance requirements. These organizational structures would prove crucial for implementing complex silver accumulation strategies that required coordination between multiple legal entities operating in different jurisdictions. Timing considerations that influenced the Hunt brothers' entry into silver speculation included their assessment of global economic conditions, monetary policy trends, and political developments that seemed to favor tangible asset investments over traditional financial securities. Their analysis of 1970s economic conditions convinced them that massive monetary expansion and government fiscal irresponsibility would inevitably lead to currency debasement that would benefit holders of precious metals and other tangible assets. By 1973, the Hunt brothers had established themselves as serious players in global commodity markets, while accumulating the financial resources, market knowledge, and organizational capabilities necessary for attempting the most ambitious precious metals speculation in history. Their decision to focus on silver rather than gold reflected careful analysis of market conditions and supply characteristics that seemed to offer superior opportunities for price manipulation and extraordinary investment returns. Silver obsession. The Hunt brothers' systematic analysis of precious metals markets during the mid-1970s led them to conclude that silver offered superior investment opportunities compared to gold due to its smaller market size, divided ownership structure, and dual role as both monetary metal and industrial commodity that created complex supply and demand dynamics. Their research convinced them that silver was fundamentally undervalued relative to gold, while possessing characteristics that made it particularly suitable for large-scale accumulation and price manipulation by sufficiently determined and well-capitalized investors. The historical relationship between gold and silver prices had maintained ratios averaging approximately 15:1 throughout most of recorded history. Yet by the mid-1970s, this ratio had expanded to over 30:1, suggesting that silver was significantly undervalued relative to gold, regardless of the absolute price levels of either metal. This historical analysis provided intellectual foundation for massive silver investments, while suggesting that price appreciation potential exceeded what might be available through gold speculation. Industrial demand factors that influenced silver markets included growing consumption by photography, electronics, jewelry, and silverware industries that created steady baseline demand, while new technological applications suggested potential for increased industrial usage. Unlike gold, which served primarily as a store of value, silver's industrial applications provided fundamental demand support that could justify higher prices while creating supply constraints if industrial users competed with investors for available supplies. Monetary history research that fascinated the Hunt brothers included documentation of silver's role as currency throughout various civilizations, suggesting that economic instability and currency debasement might recreate demand for silver as money, regardless of official government monetary policies. Their analysis of historical precedents convinced them that silver could regain monetary functions during periods of currency crisis, while providing inflation protection superior to paper financial assets. Government silver stockpile analysis revealed that official holdings had declined dramatically since the 1960s, as governments sold strategic reserves while eliminating silver content from circulating coins, creating supply shortages that could be exacerbated by large private accumulations. The US government's disposal of strategic silver stockpiles during the 1960s and early 1970s had temporarily depressed prices, while creating opportunities for private accumulation at artificially low levels. The supply constraint analysis that guided Hunt's strategy focused on the fact that annual silver mine production totaled only about 300 to 400 million ounces worldwide, while above-ground inventories were estimated at approximately 2 to 3 billion ounces, held in various forms including industrial stockpiles, investment holdings, jewelry, and decorative objects. This supply structure suggested that sustained large-scale buying could create shortages that would drive prices substantially higher. Market structure research revealed that silver trading occurred through relatively small commodity exchanges with limited regulatory oversight, modest daily trading volumes, and position limit requirements that could be circumvented through multiple accounts and offshore entities. This market structure seemed particularly vulnerable to manipulation by well-capitalized investors willing to accumulate large positions over extended periods while avoiding detection through careful position management. Investment strategy development that emerged from this analysis emphasized physical silver accumulation, supplemented by futures market positions that could leverage financial resources while maintaining exposure to price appreciation. The brothers concluded that combining physical ownership with futures positions would maximize their influence over prices while providing multiple avenues for profit realization when market conditions became favorable for liquidation. The psychological warfare element that the Hunt brothers recognized in commodity speculation included understanding that market prices reflected not only supply and demand fundamentals, but also investor psychology, media coverage, and perceptions about future price trends that could be influenced through strategic buying, publicity campaigns, and market manipulation techniques. Their approach emphasized creating market psychology that would attract additional buyers while discouraging sellers. International market analysis that supported their silver strategy included studying silver production, consumption, and trading patterns in major economies, while identifying potential allies and sources of supply or demand that could support or threaten their market manipulation efforts. Their research covered silver markets in Europe, Asia, and Latin America, while considering how international political and economic developments might influence global silver prices. The leveraging strategy that would amplify their silver exposure involved using commodity futures contracts that required only small percentages of total position value as margin deposits, while providing full exposure to price movements on much larger quantities of silver. This leverage enabled them to control far more silver than they could purchase outright, while magnifying both potential profits and potential losses from price movements. Storage and logistics planning that supported physical silver accumulation included identifying secure storage facilities, transportation methods, and insurance arrangements that could accommodate millions of ounces of physical silver while maintaining security and confidentiality about their accumulation activities. These logistical requirements became increasingly complex as their holdings grew beyond typical investment levels into quantities that approached industrial stockpile sizes. Market intelligence gathering that informed their strategy included monitoring silver production reports, industrial consumption statistics, government policy announcements, and competitor trading activities, while developing information networks that could provide early warning about potential challenges to their market manipulation efforts. This intelligence gathering enabled more effective timing of purchases and sales while identifying potential threats to their strategy. Tax optimization strategies that accompanied their silver accumulation included structuring purchases and ownership through various legal entities that could minimize tax obligations while providing operational flexibility for implementing complex trading strategies across multiple jurisdictions. These tax planning considerations became increasingly important as the scale of their silver holdings created substantial potential tax liabilities. Risk assessment analysis that the Hunt brothers conducted included evaluating potential responses from government regulators, commodity exchanges, competing traders, and international silver producers who might attempt to counter their manipulation efforts. Their risk analysis led them to believe that their financial resources and market position would enable them to overcome most potential challenges while achieving their price objectives. By 1976, the Hunt brothers had committed themselves to the most ambitious precious metals speculation in history, while developing detailed strategies for accumulating silver positions that would eventually total hundreds of millions of ounces. Their obsession with silver had evolved from intellectual curiosity about precious metals into a comprehensive business plan for cornering global silver markets, while generating extraordinary investment returns through systematic market manipulation. Market manipulation. The systematic silver accumulation campaign that the Hunt brothers launched in 1976 represented one of the most sophisticated and ambitious commodity manipulation schemes ever attempted, combining careful market analysis with aggressive purchasing strategies designed to create artificial scarcity while avoiding regulatory detection through complex organizational structures and international operations. Their approach demonstrated both the possibilities and dangers of concentrated wealth applied to relatively small commodity markets with inadequate regulatory oversight. The initial purchasing strategy that began the Hunt Silver Corner involved gradual accumulation through multiple commodity exchanges, offshore entities, and private transactions that avoided triggering position limit requirements, while building substantial holdings before market participants recognized the scope of their manipulation efforts. This stealth approach enabled them to accumulate significant positions at relatively low prices, while establishing momentum that would attract additional buyers and accelerate price appreciation. Organizational structure development that supported their manipulation efforts included creating networks of corporations, partnerships, and trust arrangements that could hold silver positions while obscuring the true extent of Hunt family control over silver markets. These legal structures provided operational flexibility while complicating regulatory oversight and making it difficult for competitors to assess the full scope of their market manipulation activities. The futures market strategy that amplified their silver exposure involved accumulating massive positions in silver futures contracts across multiple commodity exchanges while using different account names and legal entities to circumvent position limit regulations designed to prevent market manipulation. Their futures positions eventually exceeded 90,000 contracts, representing potential delivery obligations for over 450 million ounces of silver. Physical silver accumulation that accompanied their futures positions included purchasing and storing millions of ounces of actual silver bars and coins in secure facilities, while taking delivery of silver from futures contracts to remove supplies from available market inventories. This combination of paper and physical positions maximized their control over silver supplies while creating genuine scarcity that justified higher prices. International coordination that supported their manipulation scheme involved partnerships with wealthy Middle Eastern investors, particularly members of Saudi royal family, who provided additional capital and political protection while sharing the risks and potential profits of silver market manipulation. These international partnerships enabled larger position sizes while providing diplomatic immunity and political influence that complicated regulatory responses. The price manipulation techniques that the Hunt brothers employed included coordinated buying at strategic times, spreading rumors about silver shortages, and timing purchases to maximize psychological impact on other market participants, while creating momentum that would attract additional speculative buying. Their market manipulation created self-reinforcing cycles where rising prices attracted more buyers, which drove prices even higher. Media management strategies that supported their market manipulation included careful public relations campaigns that emphasized silver's monetary history, industrial importance, and limited supplies, while avoiding specific discussions of their own holdings or market activities. Their public statements about silver markets helped create favorable investor psychology while providing intellectual justification for higher silver prices. The regulatory evasion techniques that enabled their massive position accumulation included using multiple account names, offshore entities, and complex legal structures that made it difficult for regulators to track their total silver exposure, while staying technically within legal requirements that were designed for smaller-scale trading activities. Their sophisticated legal arrangements exploited gaps in regulatory oversight while maintaining plausible legal defenses. Storage facility management that accommodated their growing silver holdings included contracts with precious metals dealers, bank vaults, and specialized storage companies that could secure millions of ounces of physical silver while maintaining confidentiality about the identity of owners and the quantities involved. These storage arrangements became increasingly complex as their holdings exceeded normal commercial storage capacities. Market intelligence networks that informed their trading decisions included relationships with silver miners, industrial consumers, precious metals dealers, and competing traders who could provide information about supply conditions, demand patterns, and potential threats to their market manipulation efforts. This intelligence gathering enabled more effective timing of purchases while identifying opportunities to influence market psychology. The financing strategies that supported their silver accumulation included using petroleum assets as collateral for bank loans, margin accounts with commodity brokers, and credit facilities that enabled them to control far more silver than they could purchase with available cash. This leverage amplified their potential profits while creating dangerous vulnerabilities if silver prices declined significantly. Competitive intelligence gathering that monitored potential threats to their strategy included surveillance of other large silver investors, industrial consumers who might release stockpiles if prices became too high, and government agencies that might intervene to prevent market manipulation. Their intelligence efforts helped them anticipate and counter potential challenges while adapting their strategy to changing market conditions. International arbitrage opportunities that supported their manipulation efforts included identifying price differences between various silver markets and exploiting these differences through simultaneous buying and selling activities that captured profits while building larger overall positions. These arbitrage activities helped finance their accumulation while demonstrating their sophisticated understanding of global silver trading networks. Legal opinion procurement that provided protection for their activities included obtaining advice from prominent attorneys about commodity trading regulations, position limit requirements, and market manipulation laws, while structuring their activities to maintain technical legal compliance despite the obvious intent to manipulate silver markets. These legal protections proved crucial when regulatory challenges eventually emerged. By 1978, the Hunt brothers had established themselves as the dominant force in global silver markets, while accumulating positions that represented unprecedented concentration of commodity ownership by private individuals. Their systematic manipulation had driven silver prices from approximately $5 per ounce to over $10 per ounce, while creating market conditions that would support even more dramatic price increases as their strategy reached its climax during 1979 and 1980. Corner strategy. The evolution of the Hunt brothers' silver manipulation into a full-scale market corner during 1978 and 1979 represented the most ambitious attempt by private individuals to control a global commodity market, involving coordination of physical silver purchases, futures contract accumulation, and strategic partnerships with international investors that created artificial scarcity while generating enormous paper profits. Their corner strategy demonstrated both the potential for concentrated wealth to influence market prices and the systemic risks created when manipulation efforts reach scales that threaten market stability. The corner mechanism that the Hunt brothers implemented involved simultaneous control over both current silver supplies through physical ownership and future silver delivery obligations through massive futures positions that created situations where other market participants would be forced to purchase silver from them at whatever prices they chose to demand. This classic cornering strategy required maintaining sufficient financial resources to continue accumulating silver while preventing competitors from obtaining alternative supplies. Physical delivery strategy that supported their corner involved taking delivery of silver from futures contracts rather than settling for cash, removing millions of ounces from available market supplies while forcing short sellers to find physical silver for delivery from increasingly constrained inventories. Their willingness to accept physical delivery surprised many market participants who typically settled futures contracts for cash rather than handling actual commodity delivery. The partnership arrangements with Saudi investors, particularly Prince Faisal and other members of the Saudi royal family, provided additional capital and political protection while enabling position sizes that exceeded what the Hunt brothers could achieve independently. These international partnerships brought their combined silver control to levels that represented significant portions of world silver supplies, while complicating potential regulatory responses. Market psychology management that sustained their corner strategy involved creating beliefs among other traders that silver shortages were genuine and permanent rather than artificially created, encouraging additional speculative buying while discouraging sales by current silver holders. Their success in managing market psychology enabled them to maintain upward price momentum even as their manipulation became increasingly obvious to sophisticated observers. The inventory control mechanisms that enforced their corner included monitoring silver flows through major markets, identifying potential sources of competing supply, and implementing strategies to prevent silver from reaching markets in quantities that might threaten their price manipulation efforts. This inventory control required extensive intelligence gathering and occasional strategic interventions to maintain scarcity. Financial leverage optimization that maximized their silver exposure involved using credit facilities, margin accounts, and complex financial instruments that enabled them to control silver worth billions of dollars while using only hundreds of millions in actual capital. This leverage multiplied their potential profits while creating enormous vulnerabilities if silver prices declined or if creditors demanded additional collateral. The regulatory compliance strategy that enabled their massive accumulation included careful legal structuring of their positions, technical adherence to reporting requirements, and sophisticated arguments about the legitimacy of their trading activities while avoiding actions that would clearly violate commodity trading laws. Their legal compliance efforts proved crucial for maintaining their positions when regulatory scrutiny intensified. International market coordination that supported their corner strategy involved monitoring silver trading in London, Zurich, Hong Kong, and other major markets, while implementing strategies to prevent arbitrage activities that might undermine their price manipulation efforts. This global coordination required sophisticated understanding of international silver trading networks and currency relationships. The timing coordination that maximized the effectiveness of their corner strategy involved synchronizing major purchases with market conditions, economic announcements, and psychological factors that would amplify the impact of their buying while creating maximum upward pressure on silver prices. Their timing strategies demonstrated sophisticated understanding of market psychology and technical analysis. Industrial supply disruption that resulted from their corner strategy included shortages of silver available for photography, electronics, jewelry, and other industrial applications as their hoarding activities removed supplies from normal commercial channels. These industrial shortages created additional upward pressure on prices while generating complaints from silver consumers who faced higher costs and supply difficulties. The cash settlement resistance that characterized their strategy involved insisting on physical delivery of silver from futures contracts rather than accepting cash payments, forcing counterparties to obtain actual silver for delivery while maintaining pressure on physical silver supplies. This delivery strategy distinguished their approach from typical financial speculation and created genuine commodity shortages. Price discovery manipulation that sustained their corner involved strategic purchases at key market moments, coordinated buying through multiple accounts, and timing strategies that created artificial price momentum while preventing normal market forces from determining silver values. Their manipulation of price discovery mechanisms enabled them to maintain control over silver markets for extended periods. Competitive supplier neutralization that protected their corner strategy included monitoring potential sources of competing silver supplies, implementing strategies to prevent silver releases from government stockpiles or industrial inventories, and occasionally purchasing silver from competitors to prevent market destabilizing sales. These defensive measures proved crucial for maintaining their market control. The margin requirement management that sustained their leveraged positions involved maintaining adequate collateral with commodity brokers, managing credit relationships with banks, and optimizing their use of available credit facilities while avoiding margin calls that might force premature liquidation of their silver positions. This financial management became increasingly challenging as their positions grew larger and more leveraged. Risk monitoring systems that tracked threats to their corner strategy included surveillance of regulatory activities, competitive responses, industrial silver releases, and international market developments that might undermine their position. Their risk monitoring enabled rapid responses to emerging threats while providing early warning about potential challenges to their strategy. By early 1980, the Hunt brothers had achieved effective control over silver markets, while driving prices from under $10 per ounce to over $40 per ounce, generating paper profits exceeding $4 billion, while creating the most successful commodity corner in modern history. However, their success had also created systemic risks and regulatory responses that would soon threaten the sustainability of their unprecedented market manipulation. Silver Thursday, March 27, 1980, forever known as Silver Thursday, marked the spectacular collapse of the Hunt brothers' silver empire, as prices plummeted from over $21 per ounce to under $11 per ounce in a single trading session, while margin calls exceeding $1.7 billion destroyed their ability to maintain their massive leveraged positions. The day's events demonstrated how quickly even the most successful market manipulation schemes could unravel when leverage, regulatory pressure, and fundamental market forces converged to overwhelm the financial resources of even the wealthiest private speculators. The regulatory intervention that precipitated the crisis began with the Commodity Futures Trading Commission and major commodity exchanges implementing emergency measures designed to prevent further market manipulation, including increased margin requirements, position limits, and restrictions on new long positions in silver futures. These regulatory changes eliminated the Hunt brothers' ability to maintain their massive leveraged positions while forcing them to provide additional collateral or face liquidation. The margin calls that triggered the collapse totaled over $1.7 billion as commodity brokers demanded additional collateral to secure the Hunt brothers' massive silver futures positions that had become inadequately collateralized as their leverage exceeded safe levels. These margin calls exceeded their available liquid assets while creating forced selling pressure that accelerated price declines and generated additional margin requirements in a self-reinforcing cycle. Market psychology reversal that accelerated the collapse involved rapid shifts from euphoria to panic as silver traders recognized that the Hunt brothers' manipulation was unsustainable, while regulatory intervention eliminated the artificial scarcity that had supported inflated prices. Fear of further price declines created momentum for additional selling, while eliminating buyers willing to purchase silver at elevated prices. The forced liquidation process that destroyed their positions involved massive sales of silver futures contracts and physical silver holdings as the Hunt brothers attempted to raise cash to meet margin calls while preventing complete financial ruin. These forced sales created overwhelming selling pressure that drove prices lower, while eliminating any possibility of maintaining their corner strategy. Banking crisis implications that emerged from the Hunt brothers' collapse included potential losses at major banks that had provided financing for their silver speculation, threatening financial stability while demonstrating the systemic risks created when private speculation reached scales that could influence entire financial markets. Several major banks faced potential insolvency if the Hunt brothers defaulted on their enormous obligations. The Engelhardt Industries silver loan that provided temporary relief involved borrowing 19 million ounces of physical silver to help meet margin calls, while providing time to organize more systematic liquidation of their positions. This emergency loan demonstrated the extraordinary measures required to prevent complete market collapse, while highlighting the scale of the Hunt brothers' silver holdings and obligations. Bache Halsey Stewart Shields, the Hunt brothers' primary commodity broker, faced potential bankruptcy as their clients' inability to meet margin calls threatened losses exceeding the firm's capital reserves, while creating obligations that could destroy one of Wall Street's prominent brokerage houses. The brokerage firm's survival required emergency financial assistance while demonstrating contagion effects from commodity speculation. The Federal Reserve intervention that prevented broader financial crisis included emergency lending facilities and coordination with major banks to contain the systemic risks created by the Hunt brothers' collapse, while maintaining financial market stability. Federal Reserve Chairman Paul Volcker later described the situation as one of the most serious threats to financial stability during his tenure. International market spillover effects that accompanied Silver Thursday included price volatility in global precious metals markets, disruption of international silver trading, and concerns about the stability of commodity markets generally, while demonstrating how private speculation could create international financial instability. Silver markets in London, Zurich, and Hong Kong experienced similar price collapses and trading disruptions. The psychological trauma that affected commodity markets following Silver Thursday included lasting skepticism about precious metals investments, increased regulatory scrutiny of commodity speculation, and changes in market structure designed to prevent similar manipulation attempts. The collapse fundamentally altered perceptions about commodity market stability while influencing trading practices for decades. Legal consequences that emerged from the collapse included investigations by multiple regulatory agencies, civil lawsuits from investors and counterparties, and criminal inquiries into potential market manipulation charges. The Hunt brothers faced years of litigation, while regulatory authorities implemented changes designed to prevent similar market manipulation attempts. Media coverage of Silver Thursday created lasting public awareness of commodity market risks, while generating political pressure for increased regulation and oversight of futures markets. The dramatic nature of the collapse captured public attention while providing cautionary tales about the dangers of excessive leverage and market manipulation. The wealth destruction that resulted from Silver Thursday eliminated approximately $4 billion of the Hunt brothers' paper profits, while forcing sales of other assets, including oil properties, real estate, and various business investments to meet obligations and avoid complete financial ruin. Their petroleum-based fortune, accumulated over decades, was substantially reduced within a single day. Industry restructuring that followed Silver Thursday included increased margin requirements for commodity futures, strengthened position limits, improved surveillance systems, and enhanced regulatory coordination designed to prevent similar market manipulation attempts while maintaining legitimate commodity trading functions. These changes fundamentally altered commodity market structure and regulation. The bankruptcy proceedings that eventually consumed much of the Hunt family empire included complex liquidation processes, creditor negotiations, and asset sales that continued for years, while demonstrating the lasting consequences of failed commodity speculation. The legal and financial aftermath extended far beyond the immediate collapse, while affecting multiple generations of the Hunt family. Recovery attempts that the Hunt brothers pursued following Silver Thursday included various strategies for rebuilding their wealth through oil operations, real estate investments, and other business ventures, while avoiding further commodity speculation that had proven so destructive. Their efforts to recover from the silver collapse met with limited success, while demonstrating the difficulty of rebuilding substantial wealth after such massive losses. The lasting impact of Silver Thursday on the Hunt brothers personally included not only financial losses, but also reputational damage, legal challenges, and social consequences that affected their status within Texas society and business communities. Their transformation from respected oil heirs to symbols of speculative excess provided cautionary lessons about the risks of excessive ambition and leverage. Empire collapse. The systematic destruction of the Hunt family fortune following Silver Thursday extended far beyond their precious metals losses to encompass forced liquidation of oil properties, real estate holdings, and other business investments that had provided the foundation for their wealth, while demonstrating how leveraged speculation could threaten even the most substantial family fortunes. The collapse revealed that their silver borrowings had been secured by virtually all their assets, creating obligations that exceeded their ability to pay without dismantling their entire business empire. Debt obligations that emerged from the silver collapse totaled over $1.5 billion owed to banks, commodity brokers, silver dealers, and other creditors who had financed their speculation, while requiring asset sales and reorganization strategies that would consume years to resolve. These obligations exceeded the liquidation value of their non-oil assets, while forcing difficult decisions about which properties to retain and which to sacrifice to meet creditor demands. The asset liquidation process that began immediately after Silver Thursday involved systematic sales of real estate, art collections, personal properties, and business investments that generated cash to meet immediate obligations, while demonstrating the scope of holdings that the Hunt brothers had accumulated during decades of oil-based wealth accumulation. These sales often occurred under distressed conditions that failed to capture full market values. Oil property evaluations that determined the family's remaining wealth involved complex assessments of petroleum reserves, production capabilities, and market values that would provide foundations for debt restructuring negotiations while establishing the minimum asset base required for family survival. These evaluations revealed that oil properties remained valuable despite the silver losses, but were insufficient to restore their previous wealth levels. Banking relationship deterioration that accompanied the collapse included termination of credit facilities, demands for additional collateral, and legal actions by financial institutions seeking to recover loans that had been secured by silver positions and other assets. Major banks that had previously competed for Hunt family business now viewed them as credit risks, requiring special workout arrangements. The legal strategy development that guided their response to the collapse involved hiring prominent attorneys specializing in complex debt restructuring, commodity law, and regulatory compliance, while preparing defenses against potential criminal charges and civil lawsuits from investors and counterparties who claimed damages from their market manipulation activities. These legal costs added substantial additional expenses during their financial crisis. Regulatory investigation cooperation that became necessary following the collapse involved extensive document production, testimony, and compliance with multiple government agencies examining their silver trading activities, while attempting to determine whether criminal charges or civil penalties were appropriate. These investigations consumed enormous amounts of time and resources, while creating additional uncertainties about potential legal consequences. Family relationship strains that resulted from the financial crisis included disagreements about asset disposition, blame for the speculation decisions, and strategies for preserving remaining wealth while maintaining family unity during the most challenging period in Hunt family history. The collapse tested family bonds while forcing difficult decisions about individual versus collective interests. The business operation restructuring that preserved their core petroleum activities involved streamlining operations, reducing overhead costs, and focusing resources on their most profitable oil properties, while eliminating non-essential activities that consumed cash without generating adequate returns. This restructuring maintained their primary source of income while reducing exposure to further losses. Creditor negotiation strategies that sought to avoid formal bankruptcy included offering partial payments, asset transfers, and extended repayment schedules that would satisfy creditor claims while enabling the family to retain sufficient assets for long-term financial recovery. These negotiations required careful balancing of competing creditor interests while preserving essential business operations. Personal lifestyle adjustments that accompanied the financial collapse included selling luxury homes, reducing personal expenditures, and eliminating costly activities that had characterized their previous lifestyle, while adapting to more modest circumstances that reflected their reduced financial position. These lifestyle changes proved particularly difficult for family members who had never experienced financial constraints. The tax consequence management that complicated their recovery efforts involved substantial tax liabilities from silver trading gains, limitations on loss deductions, and complex tax planning strategies designed to minimize additional tax obligations while preserving cash for creditor payments and business operations. Tax planning became crucial for maximizing their financial recovery while avoiding additional government claims. Media management strategies that attempted to limit reputational damage included selective public statements, legal efforts to prevent damaging disclosures, and public relations campaigns designed to maintain their standing within Texas business communities while avoiding admissions that might complicate legal proceedings. Managing public perception proved challenging given the extensive media coverage of their collapse. The insurance claim investigations that sought to recover losses from various policies included directors' and officers' coverage, professional liability insurance, and other policies that might provide compensation for some aspects of their financial losses while reducing the net impact of the silver speculation disaster. Insurance recoveries proved limited relative to their total losses. Investment advisor relationship evaluation that examined their decision-making process included analysis of professional advice received, due diligence procedures followed, and risk management practices employed while seeking to determine whether professional negligence contributed to their losses. These evaluations became important for potential legal actions against advisors. Alternative investment exploration that sought new sources of income included evaluating opportunities in real estate, technology, international business, and other sectors that might provide paths to wealth rebuilding while avoiding the commodity speculation that had proven so destructive. These evaluations required careful risk assessment given their reduced financial position and increased risk aversion. The psychological impact of wealth destruction affected different family members differently, with some experiencing depression, anger, and social embarrassment, while others demonstrated resilience and determination to rebuild their fortunes through different strategies. Professional counseling and family therapy became necessary for managing the emotional consequences of their financial disaster. By 1985, the Hunt family had stabilized their financial position through debt restructuring, asset sales, and operational improvements that enabled them to maintain modest wealth while demonstrating both the resilience and limitations of family fortunes built on natural resource extraction. Their experience provided cautionary lessons about the dangers of leverage, while showing that substantial wealth could survive even catastrophic speculation if core businesses remained profitable. Aftermath. Legacy. The long-term consequences of the Hunt brothers' silver manipulation extended far beyond their personal financial disaster to reshape commodity market regulation, trading practices, and public understanding of the risks associated with concentrated wealth and excessive leverage, while providing lasting lessons about market manipulation, regulatory oversight, and the systemic risks created when private speculation reaches scales that threaten financial stability. The Commodity Exchange Act amendments that Congress enacted in response to the Hunt brothers' manipulation included stronger penalties for market manipulation, expanded regulatory authority, and enhanced investigative powers designed to prevent wealthy individuals from overwhelming commodity markets through sheer financial power. These legislative changes fundamentally altered the legal framework governing commodity trading, while establishing precedents for modern market regulation. Position limit enforcement that emerged from the crisis established clear maximum holdings for individual traders in commodity futures markets, while implementing sophisticated monitoring systems that could track positions across multiple accounts and legal entities. These limits prevented future attempts to corner commodity markets through massive position accumulation, while preserving market liquidity for legitimate commercial and investment activities. The civil litigation outcomes that resulted from the Hunt brothers' collapse included substantial settlements with investors, commodity firms, and other parties who claimed damages from their market manipulation, while establishing legal precedents for liability arising from commodity market manipulation. These settlements totaled hundreds of millions of dollars, while providing compensation for some of the victims of their speculation. Criminal investigation conclusions that addressed potential charges against the Hunt brothers ultimately resulted in limited prosecutions, despite extensive evidence of market manipulation, reflecting the difficulty of proving criminal intent in complex commodity trading cases, while demonstrating the limitations of existing criminal law for addressing sophisticated financial manipulation. The brothers avoided prison sentences while accepting responsibility for civil violations. Academic research impact that emerged from studying the Hunt Silver Corner included extensive analysis by economists, financial historians, and market researchers who used the episode to better understand commodity market dynamics, manipulation techniques, and regulatory effectiveness. This research contributed to improved theoretical understanding of market manipulation, while informing policy debates about appropriate regulation of commodity markets. The Federal Reserve policy changes that resulted from the crisis included enhanced monitoring of commodity market developments, improved coordination with commodity regulators, and increased attention to the systemic risks created by large-scale speculation in relatively small markets. Federal Reserve officials recognized that commodity market disruption could threaten broader financial stability while requiring central bank attention. International cooperation enhancement that followed the crisis included improved information sharing between commodity regulators in different countries, coordinated responses to cross-border manipulation attempts, and standardized position reporting requirements that made it more difficult for speculators to evade oversight through international operations. These cooperative arrangements became models for subsequent international financial regulation. Market structure evolution that resulted from the Hunt brothers' manipulation included changes in commodity exchange procedures, clearinghouse practices, and trading systems designed to improve market transparency while reducing vulnerability to manipulation. Electronic trading systems and computer-based surveillance gradually replaced manual trading and oversight mechanisms that had proven inadequate for detecting sophisticated manipulation schemes. The precious metals market transformation that followed Silver Thursday included lasting changes in investor attitudes toward precious metals speculation, increased institutional participation in metals trading, and development of new financial instruments that provided exposure to precious metals prices without the risks associated with physical ownership or futures market manipulation. Educational impact on business schools and financial training programs included extensive case study development, curriculum changes that emphasized risk management and regulatory compliance, and professional education programs designed to help financial professionals recognize and prevent market manipulation. The Hunt brothers case became a standard example of speculation gone wrong, while providing practical lessons about leverage and market risk. Public policy implications that emerged from the crisis included broader discussions about wealth inequality, the appropriate role of government in regulating markets, and the systemic risks created when individuals accumulate sufficient wealth to manipulate essential commodity markets. These policy discussions influenced subsequent debates about financial regulation and wealth concentration. Family legacy consequences that affected subsequent generations of the Hunt family included reduced wealth, damaged reputation, and ongoing legal and financial complications that limited their business opportunities while serving as cautionary examples for other wealthy families considering aggressive investment strategies. The Hunt name became associated with speculative excess rather than business success. The technological development acceleration that resulted from regulatory responses to the crisis included investment in computer-based surveillance systems, electronic trading platforms, and data analysis capabilities that revolutionized commodity market oversight while providing tools for preventing future manipulation attempts. These technological investments became foundations for modern financial market regulation. Industry consolidation effects that followed the crisis included increased concentration in commodity brokerage, enhanced capital requirements for market participants, and greater emphasis on risk management practices that reduced the likelihood of future broker failures from client speculation. The brokerage industry implemented stronger controls, while regulators enhanced oversight of firms with large commodity exposures. Historical assessment of the Hunt brothers' silver manipulation continues evolving as researchers gain access to additional documentation and perspective on the events, while comparing their manipulation to subsequent financial crises and market disruptions. Contemporary analysis recognizes both their sophisticated trading strategies and their fundamental underestimation of regulatory and market responses to their activities. The lasting influence of Silver Thursday on commodity market culture includes permanent changes in trader attitudes toward position limits, regulatory compliance, and risk management, while establishing cultural norms that discourage obvious manipulation attempts. The episode became a reference point for discussions about appropriate trading behavior, while influencing professional ethics in commodity markets. Modern relevance of the Hunt brothers' experience includes ongoing debates about cryptocurrency manipulation, high-frequency trading impacts, and the systemic risks created by concentrated wealth in financial markets. While providing historical perspective on the eternal tension between free markets and regulatory oversight necessary for maintaining market integrity and financial stability. When we examine the complete saga of the Hunt brothers' silver manipulation, we encounter a story that transcends simple financial speculation to reveal fundamental truths about human nature, market dynamics, and the eternal tension between individual ambition and systemic stability that continues to influence financial markets and regulatory policy more than 4 decades after Silver Thursday. Their spectacular rise and fall illustrated both the enormous potential and catastrophic risks of concentrated wealth in unregulated markets, while providing lasting lessons about leverage, hubris, and the limits of private power in global financial systems. The permanent transformation of commodity market regulation that resulted from their manipulation created safeguards and oversight mechanisms that have prevented similar large-scale manipulation attempts while preserving the legitimate economic functions that commodity markets provide for price discovery, risk management, and capital allocation. The regulatory framework established in response to Silver Thursday became the foundation for modern commodity market oversight, while demonstrating that effective regulation could prevent market abuse without destroying market efficiency. Modern financial markets continue to grapple with lessons learned from the Hunt brothers' experience, particularly regarding the appropriate balance between market freedom and regulatory oversight necessary for maintaining stability while preventing manipulation. Contemporary debates about high-frequency trading, cryptocurrency markets, and systemic risk often reference the Hunt Silver Corner as an example of how concentrated wealth and technological advantages can threaten market integrity without adequate oversight. The risk management principles that emerged from studying their collapse have become fundamental components of modern financial education and professional practice, emphasizing the dangers of excessive leverage, inadequate diversification, and speculative strategies that require continuous market appreciation to avoid catastrophic losses. Their experience demonstrates how even enormous wealth can be destroyed quickly when leverage amplifies losses during adverse market movements. Academic research into market manipulation, behavioral finance, and systemic risk has been substantially influenced by analysis of the Hunt brothers' strategies, market impact, and ultimate failure, while contributing to theoretical understanding of how markets function under extreme conditions. Their case provides empirical evidence about market psychology, regulatory effectiveness, and the complex interactions between private speculation and public policy that continue informing economic research. The technological infrastructure that supports modern commodity trading reflects many innovations developed specifically to prevent manipulation, like the Hunt brothers attempted, including real-time position monitoring, automated surveillance systems, and sophisticated data analysis capabilities that can detect unusual trading patterns before they threaten market stability. These technological safeguards represent direct responses to the regulatory failures that enabled their manipulation. International cooperation in financial regulation has been significantly influenced by the global implications of Silver Thursday, leading to enhanced coordination between commodity regulators in different countries and standardized oversight procedures that make it much more difficult for speculators to evade regulation through cross-border operations. The Hunt brothers' use of international partnerships demonstrated the need for global regulatory coordination. The cultural impact of their story on American business culture includes lasting skepticism about commodity speculation and increased emphasis on risk management practices in corporate governance, while providing cautionary tales about the dangers of hubris and excessive ambition that are regularly taught in business schools and professional development programs. Their experience became a reference point for discussions about responsible wealth management. Contemporary relevance of the Hunt brothers' manipulation includes ongoing concerns about market concentration, the systemic risks created by very large financial institutions, and the potential for technological advantages to enable new forms of market manipulation that existing regulatory frameworks might not adequately address. Their story remains relevant for understanding how markets can be threatened by concentrated power and inadequate oversight. The family's personal legacy includes both the tragic destruction of substantial wealth and the demonstration of resilience in rebuilding their lives and businesses after catastrophic losses, while accepting responsibility for their role in creating financial instability. Their experience illustrates both the costs of failed speculation and the possibility of recovery through determination and sound business practices. Legal precedents established through litigation arising from their manipulation continue influencing courts and regulatory agencies dealing with market manipulation cases, while providing framework for understanding liability and appropriate penalties for market abuse. The civil and regulatory proceedings that followed Silver Thursday created important legal precedents for addressing sophisticated financial manipulation. The psychological insights that emerge from studying their decision-making process provide valuable lessons about overconfidence, groupthink, and the cognitive biases that can lead intelligent individuals to pursue strategies that seem obviously flawed in retrospect. Their experience illustrates how success can breed overconfidence, while isolation from dissenting views can perpetuate dangerous strategic mistakes. Educational value of the Hunt brothers' story extends beyond finance to encompass broader lessons about ethics, responsibility, and the social obligations that accompany great wealth, while demonstrating how individual actions can have far-reaching consequences for markets, institutions, and society generally. Their manipulation affected thousands of people who had no involvement in their speculation, while creating systemic risks that threatened financial stability. Yet perhaps the most important legacy of the Hunt brothers' silver manipulation lies in its demonstration that market forces, regulatory responses, and fundamental economic laws ultimately prove stronger than individual wealth and determination when speculation reaches scales that threaten systemic stability. Their failure proved that no private individual or family, regardless of wealth or sophistication, can permanently overcome market forces through manipulation and leverage alone. So the question that their legacy poses for contemporary financial markets concerns whether current regulatory frameworks, technological safeguards, and market structures adequately protect against new forms of manipulation and systemic risk, while preserving the innovation and efficiency that make markets valuable for economic development. Whether we view their story as a cautionary tale about greed and hubris, or as an illustration of how markets and regulation adapt to prevent abuse, the Hunt brothers' silver manipulation continues providing insights into the ongoing challenge of maintaining market integrity in an increasingly complex and interconnected financial world. If you made it through this entire journey from Texas oil wealth to the greatest commodity manipulation in history, you've witnessed one of the most dramatic examples of how unlimited ambition and enormous financial resources can create both spectacular success and catastrophic failure within global markets. Drop a lit in the comments if you were surprised by how close two brothers came to controlling a third of the world's silver supply. Or share your thoughts about whether modern regulations have actually prevented similar manipulation attempts in today's markets. This story connects directly to ongoing debates about cryptocurrency manipulation, wealth concentration, and the systemic risks created when individuals or institutions become large enough to influence entire markets. If you're interested in learning more about how modern financial regulation evolved from historical market failures, check our documentary about the 2008 financial crisis and how regulatory gaps enabled excessive risk-taking that nearly collapsed the global economy. The lessons about leverage, risk management, and market psychology that emerge from the Hunt brothers' experience remain highly relevant for understanding contemporary financial markets, investment strategies, and the ongoing challenge of balancing market freedom with adequate oversight to prevent systemic risks and protect ordinary investors from sophisticated manipulation schemes. Thanks for exploring this fascinating intersection of wealth, ambition, and market dynamics that demonstrates both the enormous potential and serious dangers of concentrated financial power, while illustrating how markets, regulators, and society ultimately adapt to prevent abuse and maintain stability in complex financial systems.